Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. Hope you are doing well. Seeing the majority of global markets near their 52-week lows, while Indian market barely is 3% away from its all-time highs feels magical, isn't it? However, there is a section of people which are extremely unhappy as their stocks hit new lows every day. I am sure there are no prizes for guessing. I am talking about investors of new age platform companies or people who've invested in these loss-making tech platform IPOs last year. Out of the lot, Nykaa, the last man standing, or since it's Nykaa, should I say the last woman standing, too has fallen. You name the stock, be it Zomato, Paytm, Policy Bazaar, Cartrade, or even Nykaa, all of them have more than halved. I am sure I can give you 10 reasons why these stocks fell like 9 pins, but my point here is not to do post-mortem analysis but talk about the future. In markets and life, as they say, past is past, but it is pertinent to learn lessons from it. So friends, the billion rupee question is this: after more than 50% fall, do these stocks become attractive? To start with, the answer to the above question depends on A. Your risk appetite and B. Your tenure of holding. Let me give you a direct answer. If you are a long-term investor, then my answer is no. If your investment style is only fundamental analysis and you derive value of the company by using valuation methods, then my answer is definitely no, as it is extremely difficult to estimate future cash flows of these loss-making companies. If you are a trader and have the stomach to take risks, then my answer is yes. In stock markets, valuations and earnings are the kings and queens of the market. A stock at an X price will be overvalued, while the same stock at an X minus 50% could become attractive. As they say, beauty lies in the eyes of the beholder. The same is the case with valuations which are relative. So friends, out of the above lot, I find Zomato the most attractive on a risk-reward basis and the attractiveness of the sector. In this video, let us analyze Zomato from purely a price action perspective. On a lighter note, when a stock starts becoming a meme stock or people start cracking jokes about it, the bottom has been made at least for the short term. We all know the memes people shared on ITC. The stock tested patience of even extremely long-term investors. But when ITC's time came, in 2022, the stock is up 55% in 1 year. I am sure you must have seen memes of people predicting the price of Zomato and the price of tomatoes being the same. The way Zomato's stock price was falling, it almost touched the price of 1 kg of tomato in Mumbai. So the question is, after this massive fall, what do we do about Zomato? My reasons are very simple why I am bullish on Zomato at the current price. Let's start with the big picture, which is the valuations. Valuations have moderated on a 63% fall in price from the top. Zomato got listed at rupees 1 trillion market cap and reached a peak valuation of rupees 1.4 trillion market cap. Now my question at that time was, how can Zomato, which is a loss-making company and burns cash every year, have a market capitalization of rupees 1.4 trillion? While Jubilant Foods, which sells Domino's pizzas, generative massive cash flow, trades at a 60% discount to Zomato. If your starting point was wrong, I am sure the result is not likely to be materially different. And that is exactly what happened where Zomato got derated. As in the first place, it never deserved those valuations. Now that the valuations have moderated, rather, let us look at Zomato logically. Zomato a year ago with much worse financials was available at rupees 1.4 trillion market cap, while today the same Zomato with better financials and lower cash burn is available at a 60% discount. I will talk about the improved performance and management commentary a bit later in the video. One more reason why the stock fell sharply was the expiry of the pre-IPO lock-in, which saw massive supply overhang in Zomato. To add to it, initial investors like PE fund Moore and Uber completely exited Zomato, leading to massive supply, taking the stock to an all-time low. With major PE funds exiting Zomato and supply being absorbed by marquee domestic mutual funds, the risk supply overhang doesn't exist for Zomato, unlike many of its new listed peers in the platform and tech space. So while the above 2 points were from the perspective of valuation and stock price, let us talk about the fundamentals and certain logical points related to the industry. Let me give you some industry statistics. India, with a population of 1.38 billion, has internet penetration of 49% as compared to USA and China, which has an internet penetration of 94% and 68% respectively. Just imagine what will happen if we reach China's internet penetration in 10 years. Also, you will be shocked to know these two statistics. 1. Home cooked food accounts for 90% of food consumption, while only 10% is catered through restaurants. Secondly, out of all the internet users in India, only 8% of them use online food delivery apps. Just imagine the scope of the addressable market of the food delivery industry. As per research, an average household in a metro city orders food from outside only twice a month. In fact, in Tier 1 and Tier 2 cities, the average is only once a month. You know, if you take all the above statistics and add them up, just imagine the headroom for growth. A rise 1. In internet penetration, 2. Increase in frequency of ordering, I mean only twice a month, even if it becomes thrice, the industry volumes will go up by 50%. And third, increase in the order value, even if I assume a 5 to 8% rise every year, the numbers are encouraging. In all this, I haven't even spoken about increase in working population and the penetration of these apps in villages. In short, the industry size can balloon to a crazy number. Currently, the food delivery market is $57 billion in India, while USA and China are at $552 billion and $613 billion respectively. Even Brazil is at $83 billion food market. If all these factors converge, the growth will be exponential. While you look at the industry dynamics, it is a duopoly, with only Zomato and Swiggy having about 50% market share each. Personally, I believe if competition wanted to come in, they would have come in till now. In fact, there were talks of Amazon entering, but nothing has happened till now. Considering the cash burn required to establish the business, it is difficult to enter at a time when the cost of money is increasingly becoming expensive. I believe over the years, as both players want to generate profit, rationality will prevail, just like it happened in the telecom sector, where after 3 years, Jio stopped its freebies with the intention to make money that benefited the industry. In a jungle, the lion and the tiger become friends so that both get to eat the prey and nobody sleeps hungry. Coming to Zomato as a company, I like 2 or 3 things which they are doing. One is their cash burn has significantly come down. In fact, during the last quarter, the company's food delivery business was adjusted EBITDA breakeven, while the company is on the track to bring the entire Zomato business to EBITDA breakeven. Secondly, there is a lot of people, including me, who were skeptical about the Blinkit acquisition. The company overpaid. Now, that is in the past. But the encouraging factor is that the company has cut infusing additional funds in Blinkit from $400 million to $320 million and has also clearly stated that it is not going to make any further minority investments in companies as preserving cash is one of its main priority. This is really encouraging. In fact, the losses have been narrowing every quarter. So, to end this, net, if you evaluate things for Zomato, many levers have started firing together. Imagine A, you are in an industry which is having supernormal growth due to all the factors I have mentioned in this video. B, competition is limited and expected to be a duopoly for a long period of time. C, as there are only two players and both at some point want to earn profit, rationality will prevail. Aren't all these a Goldilocks scenario? On top of it, Zomato is getting its act together and the stock has corrected by 60% from the top. While I can't predict the exact bottom, but I can tell you that it definitely looks interesting from the short and the medium term. Thank you guys for watching the video and do let me know if you have any suggestions or comments.